Hello guys, it's Marcos Mia, and today we're going to go over my 4 favorite ETFs or exchange traded funds that you guys can buy today that will allow you guys to build your wealth and make as much money as possible in the least amount of time as possible. For anyone who doesn't know what an ETF is or wants to practice on their investing stock knowledge, here's what it is. An ETF is basically a huge basket of stocks that you can buy into, and when you do, you own a small portion of everything in that basket. The benefits of owning an ETF will allow you to be diversified and have less risk than owning a single individual stock. ETFs are also professionally managed investments, which is great for hands-off investors. Now, there's very minimal work with investing with ETFs. You don't have to research stocks all day or listen to every earnings report. All you have to do is continually invest in it every day, and that's it. Now let's get started with my 4 favorite ETFs to invest in, and stay till the end for some honorable mentions. Coming in at number 1 is VOO, or the Vanguard S&P 500 ETF. VOO invests in stocks in the S&P 500 index, representing 500 of the largest US companies. VOO's top holdings include Apple, Microsoft, Amazon, Google, and Berkshire Hathaway. VOO's expense ratio is a mere 0.03%, meaning that if I invest $10,000 into VOO, the fund managers will charge me $3 to hold my investment. It also has a dividend yield of 1.69%. At the time of this recording, VOO's 5-year return has been 45.54%, meaning that if I invested $10,000 into VOO just 5 years ago, I would have profited over $4,500. Now, why should you invest in VOO? Well, VOO has high potential for investment returns and is an excellent ETF for beginners and experienced long-term investors alike to have one set it and forget it diversified investment. Coming in at number 2 is VTI, or Vanguard's Total Stock Market ETF. VTI invests in over 3,900 of the best US companies, meaning by buying one slice of this ETF, you get pretty much exposure to all of America, including the large caps, mid caps, and small caps. VTI's top holdings include Apple, Microsoft, Amazon, Google, and Berkshire Hathaway. VTI has an expense ratio of 0.03%, meaning per every $10,000 I invest into VTI, I will have to pay the fund manager $3 for that investment. It also has a dividend yield of 1.65%. At the time of this recording, VTI's 5-year return is 42.57%, meaning if I invested $10,000 into VTI 5 years ago, I would have profited over $4,200. Now I know what you're thinking. What's the difference between VOO and VTI? Well, VTI includes more stocks for diversification, and it includes the small caps, which the VOO does not include. It includes more of a large cap and mid cap blend. To wrap up, VTI is one of the best buy and hold ETFs forever. I highly recommend it for anyone starting out in their investment journey. Now coming in at number 3, we have QQQ by Invesco. Now the QQQ invests in the NASDAQ 100, or 100 of the world's leading technology growth stocks. QQQ delivers exposure to companies that are at the forefront of transformative long-term themes, such as augmented reality, cloud computing, big data, mobile payments, streaming services, electric vehicles, and more. QQQ's top holdings include Microsoft, Apple, Amazon, Google, and Nvidia. QQQ has an expense ratio of 0.2%, meaning for every $10,000 I invest into QQQ, I have to pay out the fund managers $20. It also has a dividend yield of 0.81%. Now, the reason why the dividend yield is much lower than other ETFs is because technology stocks typically invest their profits back into the company, and they don't give as much of a dividend to the shareholders. At the time of this recording, QQQ has a 5-year return of 73.23%, meaning if I invested $10,000 into QQQ 5 years ago, I would have profited over $7,300. Now, if you want an ETF that has a higher allocation to technology stocks that's a little bit more risky with the potential to outperform the market, then this might be the ETF for you. Now coming in at number 4, last but not least, we have SCHD, or Charles Schwab's US Dividend Equity ETF. SCHD invests in over 100 stocks focused on quality and sustainability of dividends. These dividend stocks that are inside SCHD pay the shareholder to hold their stock, and these shareholders can use it for passive income. SCHD's top holdings include Broadcom, Verizon, Texas Instruments, Home Depot, and Cisco Systems. SCHD has an expense ratio of 0.06%, meaning for every $10,000 I invest into SCHD, I have to pay out the fund managers $6. It also has a high dividend yield of 3.38%. At the time of this recording, SCHD's 5-year return has been 49.48%, meaning if I invested $10,000 into SCHD 5 years ago, I would have profited almost $5,000. Now, why should you invest into SCHD? Well, SCHD is great if you want dividend growth, a high yield, diversification, lower volatility, and overall great returns. Now, there are over 3,000 ETFs in the stock market, and I know there's an ETF for you. So if you invest in ETFs, this could be you, followed by some honorable mentions. Now, my final thoughts at the end of this video is to always dollar cost average. That means buy stocks or ETFs at the highs, at the mids, at the lows, and always stick with the long-term mindset. We're thinking 5 years, 10 years, maybe even decades out into our investing journey to see these real returns. With over thousands of stocks to invest in the stock market today, it may be confusing on where to get started and which stocks are going to be winners or losers. But it's honestly really as simple as investing in an S&P 500 ETF like VOO or a US total stock market ETF like VTI. Now, as always, thank you guys so much for watching this video. Please leave a like and click the subscribe button for future videos. I really do appreciate you guys, and thank you so much for watching. See you guys next time.